The topic of trend reversals can be pretty tricky for some traders because a trend is a very subjective thing to begin with. And then to add to that the definition of when that trend is broken, well, that is something that a lot of traders have struggled with. So what I'm going to show you here is how I've, number one, defined a trend, and number two, defined when that trend is broken. So many of you are already familiar with the 34 EMA wave and what it looks like within the context of an uptrend or a downtrend. This view here of the 4-hour New Zealand dollar US dollar pair is a textbook example of what happens when a trend takes on a 4 to 6 o'clock angle, a downtrending angle, and begins to push to lower lows. So when you have this view, we can define this as a trend. Now the trend here is defined by the 34 EMA wave, and in addition to that, I can also use the red grab candles to confirm the bearish sentiment and momentum. And of course, it's the organization of sentiment that leads to momentum, and it's the organization of momentum that eventually turns into a trend. So all this started with traders getting bearish, that bearish sentiment, that bearish opinion culminating into a push to lower lows, and then the lower lows pushing to what ultimately became this trend on the 4-hour chart. What are other tools we can use to define a trend? Well, another thing that I could do here would be simply to connect some of the trend lines, or some of the touch points to create a trend line. Now, I will tell you the problem with trend lines, in my opinion, are they're excellent tools when it comes to trend reversals, but they are incredibly lagging when it comes to actually defining the trend. So trend lines are great to confirm a trend reversal, which is the topic of our discussion. So within that view, trend lines are perfect, again, to define a trend reversal. But I think, again, they are very lagging when it comes to actually defining the trend itself. Now let's take that same pair, but apply some different tools to the chart in order to find an alternative way to define a trend. So what we'll do here is we'll go into the list of indicators that I have running on this chart, and I'll show you two of the simple moving averages that I have running here. One is a 20-period simple, which I've colored in dark gray. Another one of the colors I sometimes use for this is a silver color. The other moving average on this chart is the 200-period simple. These are two moving averages that I recommend everybody have on their charts. Another moving average that we're going to add to this is the 50-period. And in combination, these three are often used to define a trending market. So you can see here the 20 period, which is a thinner gray line, the 50 period, which is the thicker grayish or silver line, and then finally the black line, which is a 200 period simple. When price action is trading below all three, you can see in this situation, I've got the 34 EMA wave here, so don't let that distract you. Just focus on these three lines. And what you'll see is that prices are finding consistent resistance along the 20 period simple. The 50 period is trading above it, and then the 200 period is trading above that. So a lot of traders could say that the moment that both the 20 and the 50 were trading below the 200, or when the 20 crossed below the 50, that was the beginning of a downtrend. So again, there's still a lot of subjectivity here, but what I'm showing you is an alternate way to define a trend reversal. So a short-term trend, or I should say define a trend. So the trend reversal would then now be defined into short-term and medium-term trend reversals. So if the 20 period trading below the 50 and both the 20 and 50 trading below the 200, as is the case here, defines not only the short-term, intermediate, but say maybe even longer-term downtrend, especially once prices break the 200 period themselves, not just the moving averages. So when you have all three of those things occurring, if prices trade up higher through the 20 period, that could be defined as a short-term trend reversal. If prices trade up higher through the 50, again, it's a slightly longer-term trend reversal. And then if they actually break up higher through the resistance of the 200, there becomes a really significant shift in psychology whereby the 200 period is broken, and traders will take note of that. It's a very common scan. It's a very common line in the sand for a lot of traders, especially when it's applied to the daily chart. So there are now 3 ways we just discussed: the 34 EMA wave, trend lines, as well as a combination of the 20 period, 50 period, and 200 period simple moving averages that we can use to define a trend, and also how, when these particular lines and levels are broken, we can now define a trend reversal.